or welcome back to our second show at the NFO Rush Hour. While the first hour was with ABSL Asset Management Company, the link of which I will leave in the description box if you viewers missed watching that, today's webinar is rather a very interesting one, something that will clear the financial cobwebs, if I may say. The MyFundBazaar Initiated Show reveals to you today, which we believe a lot of you have been inquisitive about, a fund that is aimed at investors like you and me looking to diversify our portfolios along with systematic, disciplined exposure to large cap, mid cap, and small cap segments. That's right, viewers, the HDFC Multi Cap Fund. To dig in this NFO tunnel further, we have Mr. Ameya Dewoolkar, who is a product specialist at the HDFC AMC.
Thanks, Shruti. As you rightly said, this is one of the funds that most of the investors have been waiting for. As you are aware, as some of you would be aware, HDFC Multi Cap Fund is an open-ended equity scheme investing in different market cap segments, large cap, mid cap, small caps. The NFO opened on 23rd of November and concludes on 7th of December. Most importantly, it's like a one-stop solution for investors looking to get stability of large caps, potential of mid caps, and growth of small caps through a single scheme. So that's just to put the scheme details or strategy in brief.
A little more about Mr. Dewoolkar. He has been a chartered accountant and a chartered financial analyst with an overall experience of more than a decade. It is an honor for us at the MyFundBazaar Academy to have you on board, Mr. Dewoolkar.
On the screen right now, that's how the portfolio will be constructed. The remaining 25%, as you can see, is the flexible component of the portfolio, which can be invested across market cap segments. So it can be invested in large caps, mid caps, small caps, as per the fund manager's discretion. It can also be invested in debt or money market instruments. So that's where the fund manager's tactical discretion comes into the picture. But most importantly, at any point in time, the fund will invest at least 25% of the total assets in large caps, 25% in mid caps, and 25% in small caps. So in that sense, any investor who comes into the fund has better visibility or clarity in terms of where his money is going to be invested in, which segment of the market money is going to be invested in, and more importantly, he'll have a disciplined, controlled exposure across market cap segments at any point in time. So as you can see here on the portfolio construct, you'll get a good, well-diversified portfolio across market cap segments in this particular fund. Where does it fit exactly in terms of risk-return profile? So a multi-cap fund is higher up the ladder in terms of risk return potential vis-a-vis a large and mid cap fund or a flexi cap fund or an outright large cap fund. So the fund invests at least 25% of its total assets in small caps, which means that it has a greater risk probability as compared to a large and mid cap or a flexi cap fund. But at the same time, the small cap component does lend good return potential to the fund, and in that sense as well, the return potential is relatively higher as compared to, say, a large cap fund or a flexi cap fund or a large and mid cap fund. More importantly, there are certain set of investors who may not be quite comfortable investing in an outright mid cap fund or an outright small cap fund. So even in that sense, if you compare a multi cap fund with, say, a mid cap fund or a small cap fund, it's lower in terms of risk probability. So that's where the fund or the category as such hits the sweet spot between a large and mid cap fund and an out-and-out mid-cap or a small-cap fund in terms of the risk. Industry leadership is something, so all of us have some preconceived notions that industry leadership is typically seen only in large caps, but that's not the case. You actually have industry leaders across market cap segments, be it mid-caps, small caps, and obviously in large caps as well. But it's also a function of the kind of industry a particular company operates in. So typically, you would see auto ancillaries or leaders even in the auto ancillary space figuring in somewhere in the small cap space or the mid cap space, and they typically don't or won't make the transition to large caps because of the scale of the industry, but they still are or still could be strong players in their respective industry. And in that sense, we have tried to give certain examples of a tire manufacturer, a battery company leading in their particular industry, but they're still mid caps. There is a leader in the footwear industry who's in the mid cap space, long track record, but still not a large cap company. So it ultimately boils down to the kind of industry a company operates in. And there will be certain segments of the economy which will feature largely in the mid cap space or the small cap space. And from that perspective, for an investor, just sticking to large caps may not give him the requisite exposure across various segments of the economy, and it actually means that you need to diversify your portfolio well across large caps, mid caps, and small caps to benefit from different segments of the economy. As some of you would be aware, different market cap segments outperform each other at different points in time. So it's not like large caps will always outperform mid and small caps, or for that matter, small caps will always outperform mid caps and large caps. So as you can see, over the last 16 years, last 16 fiscal years, large caps have been the best performing market cap segment in 6 years, mid caps in 3 years, and small caps in 7 years. So what it shows is that you can't really stick to one market cap segment and think that that's the best way of investing. You probably need a more diversified approach, wherein you have exposure to large caps, mid caps, and small caps. But then the question is, how much do you allocate to each of these segments? So how much or at what point in time should I invest in small caps or mid caps, and in what percentage should I allocate to each of these segments? So this is a common question that most investors face, and it's actually a very valid question, because a shift in market cap segment outperformance or underperformance for that matter is quite rapid. And before investors can actually reject their portfolio, the time has passed or the bus has passed in that sense. So that's where a professional fund manager with a fund like HDFC Multi Cap Fund can actually meet that investment need of investors to diversify across market cap segments, but also take those tactical calls as to when to skew towards a particular segment on a relative basis too. So maybe at a time when the markets are more broad-based in nature, mid caps and small caps outperform. So at that point in time, probably a fund manager could think of having relatively higher weightage to mid and small as compared to large caps, and vice versa when it's a narrow market, wherein the fund manager could think of having a relatively higher large cap exposure. Obviously, it's quite discretionary, so it's not like a thumb rule of sorts. But having that professional insight of the fund manager at play when it comes to creating wealth across segments is something which most investors can. The fund invests at least 25% of its total assets in large caps, 25% in mid caps, and 25% in small caps. More importantly, remaining 25% is a tactical allocation. So depending on the market scenario, depending on the macroeconomic environment, you'll see the fund manager taking tactical calls in terms of where to allocate across market cap segments, or for that matter, he can also invest that residual 25% or a component of that residual 25% in fixed income or money market instruments as well, if he deems fit at that point in time. HDFC as a fund house, as you're aware, has a strong track record over the last 2 decades in terms of managing diversified equity schemes. More importantly, when the fund manager has a good experience of close to 16 odd years in fund management, and he's been with HDFC for the last year and a half. He's actually been with other fund houses prior to this, and he's managed flagship schemes of those fund houses and has a good track record, which you can check for yourself when it comes to this particular fund manager, Mr. Gopal Agrawal, even before joining HDFC. So he's had a good track record. He's a known person in the industry as well, and he's actually a very good fund manager to manage a scheme like this, which has exposure across large caps, mid caps, and small caps, considering his proven or a long-term track record. In terms of the investment strategy, so this is probably the most important thing that investors would want to know. So the fund manager will follow a mix of top-down and bottom-up approach. Top-down could be basis macroeconomic conditions on the domestic front or global cues for that matter. And bottom-up approach obviously involves company-specific fundamentals, factors affecting each and every sector or company. That's the bottom-up approach. So it will be a combination of both top-down and bottom-up approach when it comes to selecting stocks in this portfolio or allocating funds in this particular portfolio. As per the current investment strategy, will be positioned around 60 to 75% in large and mid caps and around 25 to 40% in small caps. That's going to be the portfolio construct of this particular fund at this point in time in terms of the current investment strategy. Mind you, the fund will always have at least 25% of its total assets in each market cap segment. So large caps at least 25, mid caps at least 25, small caps at least 25. But at a broader level, large and mid caps put together will account somewhere between 60 to 75% as per the current investment strategy, and small caps will account between 25 to 40% as per the current investment strategy. In terms of investment style, so the fund manager actually believes in having a blended approach in terms of the kind of companies that he prefers to pick. So it will be a blended approach wherein you'll see growth companies as well, wherein you can see value companies as well, and if opportunity presents, he can even pick turnaround companies. So we won't have a style bias as such in this particular fund, wherein we'll be sticking only to growth companies or value companies or turnaround companies. So you'll have a blended approach. You'll have companies in the growth space, value space, wherever we see good opportunity for potential return generation, we'll position ourselves in that particular segment in terms of the investment style. So, just in a nutshell, we won't have a investment style bias in this particular fund. In terms of the sectoral weightages, so we'll be benchmark aware. So what it means is that we won't deviate significantly or completely from the benchmark weight. So benchmark for the scheme is Nifty Multi-Cap 500 50 25 25 index, and you won't deviate completely from that index in terms of sectoral weightages. So we can take stocks. So obviously, the stock selection is going to be active in nature. Even the sector selection will be active. This is an active fund, open-ended equity scheme. But in terms of sectoral weightages, we won't be completely overboard a sector vis-a-vis the benchmark, or we won't be like completely absent from a sector which is part of the benchmark. So that's basically the portfolio or the investment strategy in a nutshell. In terms of investment suitability, this scheme is suitable for any investor with a medium to long-term horizon and looking for a diversified exposure across large caps, mid caps, and small caps in a controlled manner. So it's like a one-stop solution from which an investor can benefit from the stability of large caps, the potential of mid caps, and the potential of small caps, and the growth of mid caps in a single scheme. So it's actually a good one-stop solution for diversification across market cap segments, and obviously for an investor with a medium to long-term horizon, considering that this is an equity-oriented scheme. So with this, I think, Shruti, I think I'll hand it over to you for any questions or any insights from you on this particular fund or the category.
Thank you for the insightful knowledge on the NFO, Mr. Dewoolkar. Viewers, if you agree with me, take a moment to hit the like button, smash it in fact, to tell us how much you needed to be aware of the HDFC Multi Cap Fund. I am now going to take up some frequently asked questions, some of which out of these are questions some of you, in fact, asked us. So without further ado, I'm going to ask you the first one, Mr. Dewoolkar. So the first question is, when it comes to an NFO, why does diversification really matter as a concept in the first place?
NFO's diversification is actually a prerequisite. It's quite critical. So diversification could be along the lines of asset classes, wherein you diversify the portfolio across equity, debt, gold. It is also needed along the lines of market cap segments, like we said, large caps, mid caps, and small caps. And even within equities, you need to have a diversified portfolio across different sectors. So you can't have exposure only to one sector in the equity space. You need a diversified exposure, and that's where funds or equity oriented funds which are diversified in nature, like a multi-cap fund, actually present a good investment opportunity for investors looking to gain exposure to equity.
Okay, that's quite an insightful answer right there. Thank you for that, Mr. Dewoolkar. Moving on, can outperformance and underperformance of different market cap segments be overlooked, according to you?
I would just like to highlight a few numbers here. So I think in one of the slides that we showed in the presentation, you could see that over the last 16 fiscal years, large caps have been the best performing market cap segment in 6 years, mid caps in around 3 years, and small caps in 7 years. So what it shows is that one particular market cap segment doesn't outperform year after year for a very long period of time, and it's actually difficult to time these changes or shifts in market cap segment outperformance or underperformance. And that basically means that as an investor, you need to have exposure to large caps, you need to have exposure to mid caps, you need to have exposure to small caps as well. And having a diversified exposure is probably one of the most important factors in long-term wealth creation. And you can't really ignore underperformance or outperformance of different market cap segments. You need to have a diversified exposure across different segments.
So, viewers, there it is, diversified exposure for the way, right? Okay, great. Thank you for that. Moving on to the next question. Someone has asked us to take them through the minimum investment amount during the NFO period as well as the exit load within the first year of the NFO.
The minimum investment amount is 5,000 rupees and multiples of 1 thereafter. And the exit load will be 1% if you redeem the units within 1 year from the date of allotment.
That's it, viewers. For a lot of you who had that question, that's the answer right there. I am going to take up one more question before we close today's webinar. And the last question of today's session is, speaking of tax implications, how much are the returns taxed? Speaking of the NFO.
This particular fund, HDFC Multi Cap Fund, is an equity-oriented scheme, and it will be taxed like an equity-oriented scheme. So the short-term capital gains will be taxed at 15%. Long-term capital gains will be taxed at 10% if the long-term capital gains at the investor level, at the assessee level, exceed 1 lakh during the fiscal year. For short-term capital gains, any investment with an investment horizon or investment period or holding period up to 1 year will be taxed as short-term capital gains, and any gains for a holding period greater than 1 year will be taxed as long-term capital gains with the respective tax rates which I mentioned in this answer.
So viewers, I believe, or at least hope, those Q&As have been extremely insightful and have given you more perspective into what the fund has been about. In case there are more questions, doubts, queries, please leave them in the comment section below. We will be sure to respond to your queries over there. We have come to the end of today's session. I would like to thank the HDFC team for imparting such insightful knowledge with us today. We are definitely leaving today on an enlightened juncture. So thank you, Mr. Dewoolkar, for that. I would also like to thank our viewers who would continue to believe in us and our mission of making every Indian financially literate. We care about you and your spending habits, which is why you need to stay subscribed to our official channel of the MyFundBazaar Academy towards our future uploads and notifications. So thank you for your time, and please don't forget to share this video and make your friends and family a little more wiser. And of course, I'm going to leave the details of the HDFC NFO in the description box below. This is just to remind you that the last day of the NFO is December 7th, which is literally a few days away. So if it matches your investment opportunity, you know where to head to post watching us today. That's right, in the description box below. Meanwhile, we will see you in the next video. So take care and stay safe.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.